All right, third recording for Chapter 6, more complex situations. So deferred annuities, it's when you have a period of time before your rents start to flow. Okay, so you can calculate the future value for a deferred annuity or the present value for a deferred annuity. Basically what we're going to do is calculate the annuity to some point in time and then calculate a lump sum back to the current date. An example of when you might use this could be pensions. Okay. Valuation of long-term bonds is a situation where we have two cash flows. We have a lump sum for the principal, and then we have an annuity for the interest payments. So to calculate the value of a long-term bond, you have to add together the present value of these two cash flows. So here's an example. They issued $2 million of 7% bonds due in 10 years. Interest payable at year end, so that's an ordinary annuity. The current market rate of interest of the bonds is 8%. What amount will they receive when it issues the bonds? So the market rate is 8%. The stated rate is 7%. So 7% is used to tell you the amount of the payments or the rents. Okay, so we use 7% to figure out the cash flows that will happen over the life. The 8% is what we use to discount, because that's the market rate of interest. So when we do this calculation, the first step is calculate the present value of the annuities. We're going to say it's an ordinary annuity because that's bonds pay at the end of the first year. So it's $140,000. We've got an 8% rate of interest and 10 years, so we get our factor. So the present value of the interest payments alone is $939,411. Now we have to figure out the value of the principal. So we have one payment of principal at the end of the 10 years, and that is at 8% interest. So the value of the $2 million of principal that will be paid out is $926,380. So the total value of the bond on the date of issue is the combined value of these, so $1,865,791. So this bond sold at a discount because the stated rate of interest was less than the market rate of interest. Once you have this bond, we have to create a schedule to show the effective interest method of allocating the interest. So as we did with the zero interest bonds, we have the current carrying value. We have the cash payment, so that's based on the 7%. And we have the interest expense, which is based on the 8% or the discount. So we're going to take the current principal, multiply it by 8% to find the interest expense. Our cash interest payments are the face value times the 7%, the stated rate of interest. The difference between those two is the amortization. We're trying to move this balance up to $2 million because that's what we need to pay out at the date that it matures. Concept statement number 7 talks about the expected cash flow approach. This is why we end up having to use present values for things. So when we're doing that, we need to estimate or decide what the appropriate interest rate is. Usually the appropriate interest rate is a combination of the pure rate, which is the risk-free rate of return. Pure rate plus the expected inflation rate. That gives us the risk-free rate of return. That's what the government pays, basically. And then we have to adjust that based on the credit risk of the entity you're dealing with. So here's an example where we're trying to decide how much money she needs to have on hand in 2 years to overhaul her engine. There's some uncertainty about the cost of the engines. And then she wants to know how much she would have to deposit today to have enough money then if she earned 6% compounded annually. So the first step is to estimate what she thinks she's going to need in 2 years. So to do that, she's going to do a probability assessment. So she does some research and estimates what the possible amounts are that could be owed and the probability of each. So the first step is to extend those out to calculate an expected cash flow, what the expected amount is that will need to be paid. And then she needs to calculate the present value of that. So that's the amount of money she believes she needs in the future. She needs to determine how much she would need to deposit now so that in 2 years at 6% interest she'll have $530. Okay.